The Alpha Horizon. Thinking different. Acting aware.
Welcome back to Algebris Podcasts. My name is Alberto Gallo, Portfolio Manager at Algebris Investments.
What does it mean that government bond investors are boiling frogs? Why is that?
Since the global financial crisis, central banks have been buying investment-grade credit and government debt to help economies kick the can and recover. Today, central bank assets are over 20 trillion, and the yield on available debt from governments and corporates has declined to record lows. Out of 70 trillion of sovereign and corporate debt in the world, only 1/10 yields more than 3%. This means that pension funds, insurance companies, and general savers are left with very little return on their investments. So you have two choices if you're a fixed income investor. You either accept very low yields on government debt, close to zero, so that any rise in inflation would wipe out a year of returns or more, or you go into riskier debt, and in that case you have to deal with potential default risk or volatility or currency risks. So that's why government bond investors today are a boiling frog. They have very little yield left for them, and any little rise in inflation resulting from government stimulus would wipe out returns. They're forced to go into riskier investments, but for that you need to be much more selective.
The European Union approved a €750 billion recovery fund, while the US will hold elections in November. Where do you see risks and opportunities around the world?
The European Rescue Fund is a game changer in our view. This is the first time that European countries have decided together to fund a fiscal stimulus to help southern countries and countries in a weaker situation. It is a step towards further integration. Now, European assets have often been unloved by investors, with the view that Europe was always going to be very close to this integration, with the UK exiting and maybe other countries exiting. This is a message that goes exactly in the opposite direction. So we like European credit and European equities, which are still unloved and where investors have not been buying over the last years. We also like the euro. In the United States, there's the opposite. We have a government that has started very well with corporate tax cuts at the beginning of the term, but today the US faces a very high inequality between rich and poor, and also a very bad response to the virus, which has been a late response. The Trump administration is lagging versus the Democrats, and we could see some volatility at elections. We therefore don't like so much US credit and US equities. In emerging markets, we have a bifurcated story. China has been dealing with the virus really well and it's back to pre-COVID levels, while other countries are still struggling in implementing measures to tackle the virus, like Brazil, for example, and other countries that are led by populist governments. Therefore, we prefer Europe across the globe over the US and emerging markets, but we still find value in some pockets of emerging markets.
From a strategic perspective, what are the asset classes we see value in today?
You already know that if you're buying government debt, you're getting a return-free risk. You're getting between 0 and 1% nominal yield, but very likely inflation is going to erode that yield. So you have to look for alternatives. Which are the interesting alternatives? Well, the first one is credit. Not only investment-grade credit, but also high yield, with yields that range from 4 to high single digits. We like investing in weak companies, but in strong countries that can help these companies to recover. For example, Ford in the US, or General Electric, or Boeing, or Volkswagen in Germany. These are cyclical sectors where companies have been hit by COVID, but can still recover and kick the can down the road. And in the meantime, they pay investors a yield that's much higher than inflation. Also, we like inflation-linked debt. Inflation-linked debt today is relatively cheap because inflation rates are still depressed by the virus and by the recession. However, it is possible that inflation rates may recover to pre-COVID levels, particularly in Europe, where the 750 billion stimulus that's been implemented has real chances of getting the economy back, especially in the countries that have been most hit by the virus. Finally, we also like convertibles, which are bonds that are cheaper because they were not targeted by the central bank purchase programs, but include an option on equities of the underlying companies. So you get a coupon from the bond, but you also have the option to buy the equity if the equity rises in price. Ultimately, we also think that central banks may become less independent and continue printing money, and therefore we have small positions in gold and silver in some of our funds to protect investors from the perpetuations of quantitative easing and debasement of money. Government bonds are return-free risk. The alternatives we like are credit, inflation-linked debt, convertibles, and precious metals. Thank you for listening to our podcast. Investors today face a lot more challenges than in the past. We hope that our insights will help you to navigate the challenges in markets over the coming quarters. And we'll be back with more insights over the next months.
The Alpha Horizon. Thinking different, acting aware.